Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsAndMarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Good to be with you. And, it's been, I kind of hate to say this, it's a cliche. As usual, it's been fascinating in the financial markets.
Yes, and we'll dig deep into some of that fascination. Yeah. First, we have a listener question from Michael. He says, "Hi, Jim and Bob. Bob, it seems that gold, silver, and the gold miners are in a healthy seasonal period timing-wise. Is this a good time to start accumulating for the longer term? As of late, when the overall equity markets get these big down days, gold seems to do okay, but the gold miners and silver seem to sell off along with the overall markets. Also, have agricultural commodities peaked with the rest of the commodity market, or will those reports of drought push prices higher this year?" So gold and stuff to eat.
Yeah, gold and silver, and the rush in the gold and silver stocks were up until August 2020 was outstanding. We'd got long the sector in November 2018, and then when it became extremely overbought, we advised on how overbought it was, and the advice was that traders, investors should take some money off the table. And then we've just not felt like going back in yet. I think there's going to be some symmetry here where you've got to have some more weakness in the sector than exists. Now, what happens here is that if my research works out that this is in the final stages of a great financial mania, one of the features has been is that gold's real price, adjusted by inflation, goes down. And it has with the bubble. But in the last number of months, we can say that it looks like it's trying to stabilize on the real price, nothing dramatic. Then also kind of handy with that is that copper's real price, as adjusted by inflation, goes up in the final stages of the bubble, which it did do, but it also is trying to reverse to going down. So a couple of the features we see that are a serious part of every great bubble have done what they're supposed to do and have made a little change. This could become dramatic. So what we're looking for in the gold sector is that once the big financial mania completes, then you start a multi-year bull market for the gold sector based upon not inflation, but based upon a rising real price. So the profitability improves. So we're looking for the next buying opportunity, and I think technically we should be able to get it. Also, Michael, your note about sometimes you can have a big down day in the industrials and an up day in golds. That used to happen a long time ago. I remember in the 60s, you would come in and you'd have 2 or 3 days of a sharp decline in New York. At the same time, the TSE Gold Index would be up. So that opposite action can happen at some time, but what we're doing now is focusing on watching for the next buying opportunity in the gold sector, specifically in gold. Now, also, you had a question here about agricultural commodities peaking with the rest of the commodity market. We're kind of keeping those separate, and in the regular writings cover the industrial commodities and some of the exotic ones, because what have we got here now? Cobalt and uranium are kind of at highs, but many of the ordinary commodities are not. So, and then agricultural, as you mentioned, the possibility of drought, but that was a problem last summer. But my concerns about the ag sector for North America and Europe, Northern Europe, is that we're in a cooling period where with increasing possibility of increasing precipitation. The only thing that I dare come out with on this one is that the North American growing season for the key agricultural products could be shortening, so that you get later springs and earlier frosts in the fall. So, but every once in a while, when the agricultural commodity indexes get overdone, we'll comment on it. But not much. I'm not following it too much. Well, I'm following it, but we rarely comment on it, as I say, unless you get some exceptional action. So we'll just stay with the industrial commodities. And thank you very much for your question.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob picked out some headlines to talk about today. The first one, Latin American currencies signal an economic downturn despite the commodities boom.
Yep. The lesser countries are having the problems, and this has been the way previous great financial manias have concluded, is that the discovery of a liquidity problem appears in the lesser countries, and that began last March with South Africa, Argentina, and Turkey saying that, all of a sudden we have a problem, and that's the central bank starts to run out of the reserve currency. Their local currency gets hammered and short rates go up, that kind of thing, and there's local distress. So then I've been using that term, lesser exchanges, for decades in writing about the financial markets. But then when you get to a country the size of China, I had to come up with a new term, and that was outlying exchanges. And China has joined the others in having serious financial pressures. So this is the way financial history has worked. You have the Great Bubble, it goes on, and then problems begin in, now I have to use the term, outlying countries, and then eventually they will then hit the senior financial markets such as New York and London. So at some time this will happen. I don't think there's any possibility that the authorities in China can fix this. It is just a classic of overextension, and when you're over-leveraged, the price has to go up all the time. And then you get into serious problems once the prices start down. So the mess in China is huge. There's no fixing it, I think. So, and then at some time, and don't have a handle on this one, it will hit hit London and New York, and also will show Toronto in as well.
Now we have Jeremy Grantham saying that he believes that the stock market is in a state of collapse, and we've had what I call red letter days more often, I think, than green on the board over the past few weeks. What do you think the state of the stock markets is, Bob?
Yeah, there's been some whacks to some key groups, and with longer dated interest rates rising. Actually, the T-bill rate has gone from next to nothing up to a little more than nothing. But there is risk there. I think that those headlines about Grantham, and there was a few other big name guys, hedge fund guys, who are saying the same. So one thinks, oh my gosh, there's too much noise that, this is a crazy market and it's going to crash in the market. But and talking with my colleague the other day, I said, hey, they're right. But the trick is, when does it happen? So, as I said, the contraction that has started now in China is probably unfixable. And it'll probably be inevitable that it'll hit the rest of the world, and just try and get it as best we can. Oftentimes markets can be, in November we made the daring call that there would be a Santa Claus rally. Oftentimes you can have, if there's something hugely speculative going on, it can set a high in January, but they're just kind of speculation everywhere. So we're watching things closely. There's a few of our key items are registering, for example, Royal Bank in Canada, a huge bank, as big as Wells Fargo in the States, and twice the size of Citibank. It's given accomplished technical excesses from which it can correct, and in the last couple of months, the bank stocks have been very popular. So we see there's selective rotations going on, and one sector's hot, and then for a while, and then it's not. And but somewhere it accumulates, whereby all the excesses, all of the speculative excesses, are just too much. And then it all starts to contract. And as I say, we're watching for that, because a line that I've used at the top of previous bull markets, and I used it in Thursday's piece, is that the old saying in the market that every bull market climbs a wall of worry. So maybe Grantham's, you can include that as a worry. But then I've added the line that in a rush of enthusiasm, the bulls leap over the wall only to discover that Murphy is there. And of course, Murphy's law is that everything can go wrong at some time. So we've seen the markets climb a wall of worry, and we're seeing a rush now. So we'll see if my quip about Murphy waiting appears at some time this year. Who knows when? But the markets, as this old financial historian has said, are absolutely insane. People are doing very reckless things, and they're winning on it. But if you take, for example, the NASDAQ index, and early last year, there was something like 75, about 80% of the stocks in the NASDAQ were trading above their 200-day moving averages. And now it's something like about 30% only are trading above their 200. So those that were buying at the highs last year are underwater. So this then is an underlying dampener on the market. So, but in the meantime, the action is positive, and everybody wants to be bullish, and sometime it'll burn itself out.
Another headline that caught your attention: China's developers are being hit by hidden debt concerns.
Yeah, it's. Remember we started talking about the first big property developer that was having trouble with Evergrande, and we've talked about that group for ages. And then, of course, what's happening is it's spreading to other developers, and some of those developers were perhaps on a better footing than Evergrande was. But the problem is that when the contraction starts, it gets everybody. Now, in the last few weeks in China, there's been word that the authorities are really going to help out, and da-da-da-da-da-da. So there's been quite a good rally in their junk bonds and stuff like that. But essentially, their yields, there's a junk bond index, yield index, and a year ago it was at, I think, 9% nominal yield, and it reached 30% recently, and I think the high yield in 2009 was something like 33%. So that just shows you just how much pressures there are on the low-grade bond market in China. It's quite serious.
Chicken wings, shrimp, ensnared by China's zero-COVID zeal. What does that mean? We're not going to get shrimp and chicken wings?
Yeah, I think it's the supply chain. Didn't you say you went to a place the other day and
Boston Pizza
didn't have any chicken wings?
Boston Pizza was out of real chicken wings, and
My gosh.
offered up chicken nuggets, which I don't like because I just think they're a bunch of wrapped chicken fat. Yeah.
Well, I had some chicken wings in my freezer that I bought a while ago on sale, and then recently, Jim, I got one of these new hot air fryers. So I thought, well, I've cooked a few things in it, kind of like it. So then I got the chicken wings out and let them thaw, and then patted them dry, and I made a little dredge with flour and salt and pepper and some garlic powder and onion powder, mixed it all up, threw in a little paprika for color, and then just give them a light coat, and then put them in my hot air fryer. And they came out very, very nicely. I'm so pleased. So that I'm all for chicken wings in a hot air fryer. So there you are. This show gets beyond financial history, doesn't it, Jim?
Little cooking show.
Yeah.
And,
why not?
Now, another headline: U.S. existing home sales suffer biggest December drop since 2009. Well, wasn't 2009 the big U.S. real estate collapse?
That was. In early 2009 was the worst for most everything on that contraction. So that's a startling headline. And also, I think it was adjusted for, it had seasonal adjustment for it. So anyway, it's very clear, the worst December since 2009. So, all of a sudden, whoosh, somebody pulled the pin on that sector. So,
Or it could have just been an effect of very high prices, and plus all the homes that you would like to buy had already been sold, and the stuff that was on the market was junk or not worthy of being sold.
Or too pricey or something.
Yeah.
No, you can't get in. It's tough to get into those details. I'm just impressed by the headline.
Yeah.
So what's happening here is, well, maybe last summer, the way I go about it, Jim, is just to go through a list of headlines, and you pick out the ones that are sensational but pertinent. And then through last summer, most of them were all positive, bullish, So here you now have got a mix of horror show headlines, plus certain sectors doing kind of well. So we're in a transition, but and that's a strange way of assessing the markets, but I think the headlines really tell a story, and they're worth looking at. It's sort of like rather than empirical numbers, charts and stuff like that, it's sort of a anecdotal assessment of the market forces. So that's why I always do them. They're always interesting, and they are showing a mix now. Some hot ones and some in China, disastrous ones.
Bob, always fun to chat with you.
Yep, we had some fun today, Jim, and look forward to chatting next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He was speaking to us from Vancouver. Bob loves to answer your questions, so you can send them to info@housestreet.com, just like Michael did today. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.